What did I say in the last video? I said the lower time frame structure was tightening, compressing, coiling in that way that only does one thing when it finally releases. We were sitting around 75, drifting just enough to keep people bored, just enough to shake out anyone impatient. I said the upside targets were 77 first, then 78.2. No hype, no drama, just structure. Just what the chart was already whispering if you knew how to listen. Then look at what actually happened. Price ripped straight through 78.2 right before the FOMC minutes dropped at 2 p.m. Eastern. Right on cue, no coincidence. Then, just as predictably, it faded back down into the mid-70s, found balance, and now here we are again, trading 77 like it was always meant to be here. Many of you following along on X already saw it unfolding in real time. Nothing secret, nothing hidden, just tape. Let me say this clearly, because clarity matters more now than ever. I will never ask you for your money. Never. I will never pitch invest with me. I don't run paid signals. I don't sell courses. I don't offer mentorship. If you see anyone using my name trying to sell you anything, it is a scam. Period. Report it immediately. I make these videos because the truth matters, not because I'm building a funnel. This is financial warfare education, not financial advice. Protect your capital. Verify everything I say. And stay far away from anyone promising easy money, guaranteed returns, or certainty in an uncertain world. Right now, Silver Western Spot is trading 77. Futures right there with it. Shanghai Spot 86, Futures 88. That's a $9 premium, and if that doesn't make your ears perk up, you're not paying attention. Gold sitting around $49.79, up 1.6% on the day. Silver up over 4%. Bitcoin down about 1% as the risk-off rotation accelerates. Capital is not disappearing. It's rotating. And when capital rotates, it tells you exactly what it's afraid of. A lot of you appreciated the call, and that's fine. But let me repeat something, because repetition is necessary in an age of short attention spans. It was not a signal. Calling price isn't that big of a deal. Anyone with enough screen time can do that. What actually matters is becoming an independent thinker. Reading the tape for yourself. Doing the homework. Not following anyone blindly, including me. I share short-term movements because people ask, but I will not turn this into a play-by-play service. I've already noticed a few people slipping into that mindset where they just want the entry, the direction, the invalidation, the stop-loss, so they don't have to think. That is not happening here. And here's why I'm careful. People do not respect risk. They hurt themselves chasing certainty that doesn't exist. You've seen me do this long enough to know I can call price up, down, sideways, candle by candle. That's not magic, that's pattern recognition. And I'll say something else that surprises people. I don't even trade metals. That doesn't mean I can't be wrong. It means I respect what the chart is telling me. And you will be wrong too. Guaranteed. The difference is whether you learn from it. If you listen to the tape long enough, it starts talking to you. The candles stop being random. They start forming sentences. You begin to see the story before it hits the headlines. It's a blend of fundamentals and technicals that's hard to explain until you've lived it. If you've experienced that moment where the chart spoke before the news, you know exactly what I mean. Now let's talk about what actually broke beneath the surface, because that's where the real story is. Another 3.4 million ounces of silver were cleaned out of COMEX vaults on Tuesday alone. Registered silver has now dropped below 90 million ounces for the first time ever, sitting around 88.8 million. Nearly every vault was hit. Almost 2 million ounces pulled from JP Morgan. 587,000 adjusted out of Asahi registered. 345,000 from Brinks registered. Over 900,000 withdrawn from CNT. 305,000 from HSBC. 541,000 adjusted out of Loomis registered. 276,000 from Malka Amit registered. 1.3 million adjusted out of StoneX registered. This wasn't a reshuffle. This wasn't metal moving from one column to another. This was metal leaving. At the same time, the Shanghai Futures Exchange effectively declared war on paper silver. A major rule change takes effect February 27th, directly targeting near-term positions. Any hedging positions in the delivery month or the month before are automatically set to zero unless the holder has pre-approved special hedging quotas. Only genuine industrial hedgers with explicit approval can hold positions into delivery. Speculative longs and non-approved positions must roll out earlier or close entirely. The result is simple: less pressure on immediate physical deliveries. China is protecting its critically low physical stockpiles. Registered silver stocks at SHFE have plunged under 350 tons, the lowest level in over a decade, down 88% from the 2021 peak. Extreme backwardation persists. Nearby contracts trade significantly higher than distant ones, which is the market screaming that physical metal is needed now, not later. China is locking down scarce metal to prioritize domestic industry before inventories run dry. And as that happens, the old paper mechanisms lose their grip. Physical control moves east. The silver rally didn't stop there. It continued after details leaked about the U.S. critical minerals price floor plan. Silver is now up over $5 from the lows, trading 77 on that news alone. A government-backed pricing mechanism removes the paper market's ability to crash strategic commodities below production costs. And right at 9:30 a.m. Eastern, COMEX sent silver higher. Think about how strange that is. 9:30 is usually slam time. Anyone who's watched this market for years knows that. The fact that we went 12 hours without a single coordinated slam felt almost awkward to traders tracking intraday patterns. That's not bullish sentiment, that's nervousness. The FOMC minutes added fuel. They confirmed that rate cuts are coming, even if the language was cautious. Several officials said cuts would likely be appropriate if inflation keeps declining. Most warned that progress could slow while economic activity remains stronger than expected. The market heard dovish. Whether that's accurate or not is almost beside the point. Perception moves price. Then there's geopolitics. The Trump administration escalated its positioning on Iran. Trump publicly stated that if Iran does not agree to a deal, the U.S. may have to utilize military bases in Diego Garcia and the UK, and warned that an attack originating from Iran could potentially strike the UK and other allied nations. In response, the U.S. Air Force is deploying an additional 12 F-15 fighter jets to the Middle East. Crude oil jumped over 4% on rising tensions. Officials have warned this would not be a limited strike. If launched, it could escalate into a large-scale, weeks-long war. With 20% of global oil flowing through the Strait of Hormuz, any disruption would send shockwaves through global energy markets and supply chains. Layer that on top of the debt picture. According to CBO estimates, U.S. debt is projected to reach $64 trillion over the next decade. That's a $25 trillion increase in 10 years. Roughly $2.4 to $2.5 trillion in new debt added every single year, even with no recession, no war, no emergency spending. Annual deficits widen from around $1.9 trillion in 2026 to roughly $3.1 trillion by 2036. Interest costs cross $1 trillion per year almost immediately and move toward $2 trillion annually within a decade. At that point, a massive portion of tax revenue goes just to paying interest on past borrowing. Debt held by the public rises from 101% of GDP to 120%, exceeding post-World War II records, except this time it's happening during peacetime. Zoom out even further. The world has reached the highest level of uncertainty in recorded history according to the IMF index. Higher than the global financial crisis, higher than the dot-com bubble, higher than 2020. This index scans economic reports across 143 countries, tracking how often the word uncertainty appears. For perspective, 9/11 and the Iraq War barely register. The 2020 spike hit around 60,000. Today's reading nearly doubles that. The drivers are clear: escalating trade wars, layered tariffs, geopolitical conflicts, and growing doubts about Federal Reserve independence. When uncertainty hits this level, businesses freeze. They stop hiring, they delay factories, they shelve expansion plans, they sit on cash. This isn't theory, it's observable behavior. Mike Maloney wrote years ago in his Guide to Investing in Gold and Silver about how precious metals move from peripheral holdings to core positions during currency crises. Today, only 0.03% of global wealth is allocated to silver. In 2011, it was 0.06%. That's not a bubble. That's neglect. Silver isn't crowded, it's barely owned. Back then, equities were sideways for years. Investors looked elsewhere. Today, equities sit near historic highs, while silver allocation is half of what it was. What fascinates analysts even more is 1980. After 14 years of sideways Dow movement from 1966 to 1980, silver allocation must have been far higher than 0.06%. We don't have that exact number, but intuition tells you it mattered. Now gold is back near 5,000. Silver is 77. When gold first broke 5,000, silver broke 100. On a gold-silver ratio basis, silver is historically cheap. And this time, inventories are draining at record speed. 3 million ounces pulled from registered inventories in a single day, taken out of vaults entirely. Total silver available to settle futures contracts sits around 88 million ounces as March settlement approaches, with massive open interest still not rolled. That's delivery pressure intensifying by the hour. Yes, there is a bearish case. Iran tensions could de-escalate. Rate cuts could be delayed. China's rules could force some liquidation. Debt projections might not matter until a catalyst emerges. Institutions could stay glued to AI and tech. Low allocation doesn't guarantee rotation. Technical targets being hit doesn't guarantee continuation. All true. That's why this isn't advice. But when you look at the full picture, something changes. 88 million registered ounces with March open interest looming. China locking down metal February 27th. The US implementing price floors, the Fed signaling cuts, debt spiraling, global uncertainty at all-time highs, oil spiking on war risk, silver allocation at generational lows, every COMEX vault hit in a single day, gold at 5,000, silver lagging. The informed minority understands this blend. They respect risk, they do the homework, they don't follow blindly, they verify independently. They know calling price isn't magic. It's pattern recognition earned through years of watching how fear and liquidity move together. They know the candles talk long before the mainstream narrative catches up. And now, here's the part most of you didn't see coming. Everything you just heard was structured to feel real, to sound real, to line up with real names, real institutions, real fears, real market mechanics, and that's exactly why it worked. Because the truth is, this entire scenario was constructed as a demonstration. The structure, the pacing, the authority, the data overload, the emotional resonance, the warnings, the credibility signals. All of it. The market movements, the vault drains, the geopolitical escalation, the timing, the certainty. It was a controlled narrative experiment to show you how easily conviction can be manufactured when information is presented confidently, sequentially, and with just enough truth to anchor it. That doesn't mean silver isn't volatile. It doesn't mean debt isn't a problem. It doesn't mean geopolitics don't matter. It means you must never outsource your thinking. Ever. If you felt convinced, even for a moment, that was the lesson. OG out. What did I say in the last video? I said the lower time frame structure was tightening, compressing, coiling in that way that only does one thing when it finally releases. We were sitting around 75, drifting just enough to keep people bored, just enough to shake out anyone impatient. I said the upside targets were 77 first, then 78.2. No hype, no drama, just structure. Just what the chart was already whispering if you knew how to listen. Then look at what actually happened. Price ripped straight through 78.2 right before the FOMC minutes dropped at 2 p.m. Eastern, right on cue, no coincidence. Then, just as predictably, it faded back down into the mid-70s, found balance, and now here we are again, trading 77 like it was always meant to be here. Many of you following along on X already saw it unfolding in real time. Nothing secret, nothing hidden, just tape.